Today, we're taking a close look at one of the biggest names out there, Amazon, ticker AMZN.
It's one that everyone's been watching for sure.
Absolutely. And if you've glanced at its chart recently, you might just see, well, stability, maybe even boredom. The stock seems to be taking a long, quiet pause.
It really does. It looks like it's just napping.
Right. But the comprehensive financial report we've analyzed paints a completely different picture. It frames this whole period not as weakness, but as a deliberate consolidation. A massive engine just idling before what it projects to be a huge run.
Yeah, that's the core idea. The quiet on the surface hides what's really going on underneath.
So our mission today for you is to unpack that paradox. We need to understand why the underlying financials are, and I'm quoting the report here, screaming BUI.
And why 2026 is circled on the calendar.
Exactly. Why is 2026 the year that this analysis says Amazon is set to, well, break through its old limits and really deliver?
Well, the first observation of the analysis is really the key to the whole setup. While a lot of its peers were making these sharp, kind of erratic moves, Amazon just settled.
Into that tight range.
A very tight, narrow range, right around that $230 level. The report actually pinpoints the closing price it uses for its analysis, which was $232.53 as of December 31st, 2025.
Okay.
And that little bit of stabilization right above that key support level, that's really the first clue that this nap is actually something more strategic. It's accumulation.
Okay, let's unpack that contradiction right away. Because how can a stock that's basically moving sideways for months be getting ready for a massive run? To a lot of people, it looks like it's hitting a ceiling.
Or running out of steam, yeah.
Right, running out of steam. So let's contrast that visual perception, the stock sleeping, with the internal engine, which the analysis claims is just absolutely roaring. What specific data from that Q3 2025 update makes them so confident?
So this is where it gets fascinating. It's the sheer velocity of the profitability that they've managed to unlock. And it's mostly due to execution, not just some external market tailwind.
Internal changes.
Internal changes. The Q3 2025 numbers were, well, they were stunning, especially the net income figure. It just exploded to $21.2 billion.
$21.2 billion.
Billion. And to put that into context, for a company of this scale, that level of cash generation, it represents massive, massive profitability. It blew past market expectations and even a lot of Amazon's own historical records.
So this isn't just a good quarter.
No. This is a signal that a fundamental operating leverage is finally taking hold.
So if the company is generating that kind of cash, it has to be coming from efficiency. The report does attribute the expanding operating margins directly to CEO Andy Jassy's big cost-cutting efforts. But what does that actually mean? I mean, how did he pull that off without hurting growth?
Well, the cost-cutting wasn't about, minor trims here and there. It was systemic.
A total overhaul.
Exactly. The analysis details that the margin expansion came from two main areas. First, optimizing that massive fulfillment network they have. And second, just general supply chain efficiency.
Right, because they spent years and billions just building everything out.
Billions. And now they're optimizing how they use that infrastructure. That leads to lower per unit delivery costs. And it's that kind of operational discipline that pushed net income into that record territory.
That's powerful. So you have profitability and efficiency improving dramatically.
Yeah.
But Amazon's future valuation, it's never just been about delivering packages efficiently.
Never.
The report makes it clear that the primary growth engine, the part the market is supposedly ignoring, is still AWS.
Precisely. And this is where the AI narrative really takes center stage.
Okay.
The report noted that AWS revenue is growing at a strong 19%. But critically, the analysis doesn't just see that as typical cloud growth. It sees it as cloud computing actively.
Yeah.
Re-accelerating.
Re-accelerating, so picking up speed again.
Picking up speed again. And that re-acceleration is specifically tied to the soaring demand for AI infrastructure. Companies need vast amounts of compute power, of storage, that really only AWS can provide at that kind of scale.
So their big investments in AI-ready infrastructure are actually starting to pay off now?
Measurably, with real revenue gains.
All right, this is where we get to the core insight of the whole report then. If profitability is up, the growth engine, AWS, is accelerating.
Right.
Why is the stock just sitting there? Let's play devil's advocate for a second.
Go for it.
Is the market worried that this margin expansion isn't sustainable, or is it really just fixated on that delivery truck valuation?
The analysis argues it's almost entirely the latter. The market is just fixated on the retail side.
Still sees it as a big store.
As a big store, exactly. The report says the street has been sleeping on these fundamental improvements, pricing Amazon like a successful but maybe slow-moving e-commerce company. They're valuing the fulfillment centers, but they're overlooking the cloud infrastructure.
And that's the whole thesis.
That's the whole thesis right there.
Yeah.
The report's central claim is that Amazon is a high-growth AI powerhouse disguised as a delivery company. And that discrepancy being priced cheap relative to its true potential in AI and cloud, is what makes this whole setup so compelling for the analysts.
Because that valuation gap is just too wide to ignore long term.
Exactly.
That mental shift from retailer to AI infrastructure is what you need for a big jump in valuation.
Yeah.
So let's move from the fundamentals to the technicals. The report says the price action is the giant stretching its legs.
Right.
Let's get into the actual trading mechanics that support this accumulation theory. The source material details the action around the lows of this consolidation period. It saw a low of $230.20.
Right.
But the buying pressure was instantaneous. It pushed the price right back up to close near the high at $232.53. What does that tight little band of activity tell us?
It tells us exactly what the smart money is doing. That $230 level is not an accident. It's acting like a concrete floor.
A floor.
The fact that the stock just refuses to break down below that level, even with a quiet news cycle, it signals significant institutional demand. Whenever the price dips, you have these large players stepping in and seeing it as a buying opportunity.
And that sideways movement is the accumulation.
That's the accumulation. It's boring for a casual observer, but for technical analysts, it's gold. Think of it like a giant dam holding back water. The longer it consolidates, the more energy or shares these large institutions are quietly loading up on.
Building massive positions without causing a price spike.
Without tipping their hand.
So if they're accumulating, they're getting ready for a release. Let's talk about the technical indicators that confirm this readiness, but let's define our terms here for the listener. The report mentioned the setup is textbook bullish, and it cited the relative strength index, the RSI, and moving averages.
Right.
What do those mean, and why are they bullish here?
Great question, because this is where the market mechanics really line up with the financials. So the RSI, that measures momentum. When a stock shoots up quickly, the RSI goes high, which signals it's overbought and might pull back.
Okay.
But during this consolidation, the RSI has been resetting itself. And what that means is that the sideways movement has basically cleansed out the short-term speculative jitters. It lets the momentum gauge drop back down to neutral.
So it's ready for another run without being overextended.
Exactly. And similarly, the moving averages, which just smooth out price data to show you the underlying trend, they're all starting to curl up.
Curl up.
Yeah, so even though the chart looks flat, the longer-term trend lines are decisively pointing upward. It signals that the structural pressure is building for a move higher and a clean acceleration.
Okay, so the accumulation is done, the momentum indicators are ready, the long-term trend is turning bullish. Where is the actual technical wake-up call, that release point we should be watching?
The breakout point, the one everyone's watching, is $258.
The 52-week high.
That's the one. It's the ceiling that has capped the stock's movement. The analysis suggests that once Amazon clears that resistance level, there is, and I quote, blue sky above.
Meaning not a lot of resistance after that point?
Very little. Because the consolidation has lasted so long, there's not much overhead supply. You have fewer people who are waiting to sell immediately once that old high is finally breached.
That makes the technical argument crystal clear. But let me challenge that a bit. Is it possible 258 doesn't break cleanly? That it becomes a long-term wall of sellers and the consolidation just keeps going?
That is always the risk, of course. However, the report argues that the sheer fundamental strength, that $21.2 billion in net income, will eventually just overpower that technical barrier.
So the fundamentals are the fuel?
Yes. In this scenario, the technical setup isn't leading the fundamentals. It's confirming the pent-up potential that was created by those flawless financials.
Understood. All right, so let's talk about the destination. If this giant fully wakes up and really starts running, how high are the analysts expecting it to go? We're moving from the current stability to the future expectations.
And the analyst community, as you see in this report, is extremely bullish. The overall Wall Street consensus for Amazon is a strong buy, and we have specific numbers to guide that potential upside.
What are we looking at?
The average price target, where most analysts are settling, sits comfortably at $295.
Okay, that's a nice jump.
It is. But the bull case target, so the upside potential, if that AI flywheel really spins at max speed and the margins keep improving, that's projected aggressively up to $360.
$360. So let me just do the math on that. Using the reporting price of around $232, hitting that bull case of $360, that's an upside return of over 50%.
Over 50%.
That is a massive return potential for a company of this size. And it really explains the high conviction you can feel in this analysis.
It does. And that high forecast is just intrinsically linked to the key business drivers for 2026. The main assumption is that the AI flywheel is expected to be fully spinning.
Meaning all that capital they spent is finally translating into major high-margin revenue from big companies adopting AI.
Large enterprise AI adoption, yes. And we can't forget the second growth driver either.
Advertising.
Advertising revenue. Amazon's ad platform is expected to keep up its aggressive growth, leveraging that massive e-commerce data footprint they have.
Right.
The report ultimately summarizes its bullish stance with a pretty bold claim. It says Amazon is, and this is a quote, possibly the most undervalued stock in the entire Magnificent Seven group right now.
The most undervalued, given its profitability and growth profile.
Exactly.
Wow, that's a massive conclusion. Okay, so what does this all mean for you, the listener? Let's try to bring it all back together.
Let's do it.
The quiet price action we've seen over the last few months is, according to this analysis, fundamentally deceiving. You shouldn't mistake that sideways consolidation for weakness.
It's a setup.
It's a setup. The report highlights 3 pillars that are driving what it sees as an imminent breakout. Flawless financials with record net income,
Check.
a re-accelerating cloud business fueled by AI demand,
Yeah.
and a compellingly cheap valuation relative to its true growth prospects.
And that's really the kicker. The knowledge from this analysis suggests that this long consolidation phase is over. It's complete, and the setup for 2026 is structurally sound.
So this gives you the context to understand why, institutionally, the stock isn't being seen as an idling delivery company anymore.
No, it's seen as a coiled spring. It's just waiting, prepared for that technical trigger that will push it toward that $258 breakout point and then onto those higher targets beyond.
A coiled spring. That is a powerful final image. And let's end with a final provocative thought for you, building on this whole idea that Amazon is an AI powerhouse disguised as a retailer. We know the high-end bull case is targeting $360, and that's driven heavily by AWS re-accelerating from that recent 19% Q3 growth. The question for you to consider is this: how rapidly must the volume of global AI deployment scale, not just its current adoption rate, to truly justify that aggressive 360 target in 2026?
Good question.
And what specific forward-looking metric beyond just last quarter's revenue growth should you be watching to confirm that the AI flywheel is actually spinning even faster than the bullish analysts currently anticipate? Something to keep an eye on as this market giant begins to stir.